Hey everyone, welcome to another video. So in this video, we'll try and understand the only 5 changes as far as GST is concerned in the recently announced Union Budget of 2026. Well, first and foremost, the question to address is why only 5 changes in GST, unlike in income tax where you have multiple changes. Well, as far as GST is concerned, way back in September 2025, already there was a major overhaul in terms of GST rate changes. A lot of items were changed to 5% and 18%. So therefore, GST 2.0 came into effect from 21st of September 2025 to be precise. And because of which, in the recently announced budget of 2026, there's been only 5 extra or additional changes. Why? Because a lot of the changes in GST already came into effect in September, October, November 2025. So in today's video, let's do a deep dive into these 5 additional or 5 extra changes and try to understand them. The first one is with respect to intermediary services. Well, earlier under GST, as far as the place of supply rules are concerned, for an agent or a broker coming under the definition of intermediaries, for them operating from India, for their original supplier in India, they may be providing services, let's say, to a customer located outside India. In this particular example, let's say you have an agent or broker in India and he's working for his original supplier who's also in India, and the agent or broker is providing services to a customer located outside India, in this particular case in US. Now technically this sounds like an export of service, but under GST it is not tagged as an export of service because earlier the place to supply rule said that as far as intermediary services are concerned, when an agent in India is providing services to a person located outside India, the place to supply will be the location of the supplier, which in this particular case is India itself of the agent. So therefore CGST and SGST was liable to be paid, and this was not treated to be export of services. Therefore he did not end up paying zero tax. He had to pay CGST and SGST at 18% GST rate. So because of this earlier POS rule, although technically is exporting out services, he had to end up paying CGST and SGST, and therefore there was a lot of hue and cry with intermediaries and the agents and brokers and all that. Now in budget 2026, actually in fact it was proposed in September 2025, and finally in the budget of 2026 they have thought to include a particular section in the act, so that the amendment says that the place to supply rule will now be omitted for intermediaries, and for intermediaries it will be regarded as an export of service, because now after the amendment will come into picture, the place of supply for these intermediaries will be the location of the recipient, which is the foreign customer, in this particular case in US. So earlier the place supply was in India, therefore CGST and SGST. Now after the amendment, for intermediaries and agents specifically, the place supply of the POS rule is going to be outside India, and hence this will come under the definition of export of services, and they only need to pay, they need not pay any GST at all, because it comes under the definition of export of services. So this is a major great change for intermediaries, agents and brokers, because earlier, though they were exporting out services, technically they had to end up paying CGST and SGST, and now they're exporting out services, bring in foreign exchange, and the government said that no, you don't have to pay any GST, because now the place supply is not going to be location of supplier, rather it's going to be location of the recipient, of the person to whom you are supplying, who's outside India. This is a major change, going quite favorable in behalf for these agents and intermediaries. The second change is with respect to post GST discounts. Now what often happens is, a supplier is supplying goods and services to a particular recipient, and after the supply takes place, there'll be an agreement between the supplier and the recipient saying that after supplying, let's say if you are paying within a certain amount of time, certain period of time, then you will get cash discount, for example. So this discount usually was passed on by the supplier to the recipient by way of credit notes, by raising credit notes. And earlier there was a requirement, if the recipient had to get this discount and the discount had to be reduced from the value of supply, there was a condition that one, there should be an agreement in place between the supplier and the recipient mentioning the criteria for discount after supply, and 2, if you are raising credit notes for giving the effect of discount for the recipient, then these credit notes should have been linked to the invoices was the earlier provision. Now what's happening is that the amendment, or in budget 2026, the need for having the agreement between the supplier and the recipient for discount, post supply discount, and the need for credit notes to be linked to invoices is removed, which basically means that as far as post supply discounts or incentives are concerned, the supplier and the recipient need not enter into an agreement for it, number one. Number two, the supplier can raise credit notes for giving the effect of discount, but these credit notes need not be linked to invoices for the very fact that on the GST portal today, there are facilities like the IMS and the auto reconciliation and all that between supplier and recipient. Therefore, the credit notes need not be linked to these particular invoices. So these two changes have been made as far as post GST discounts or incentives are concerned. Number 3 is regarding provisional refunds. In fact, the next change, number 4, is also regarding refunds. This one is regarding the 90% provisional refund, which earlier was only applicable to zero rate exporters. Provisional refunds is basically a criteria under GST law such that you apply for a refund of your unaccumulated input tax credit, and within 15 days you get 90% of the provisional refund from the department, and then the remaining 10% after scrutiny or whatever. Now earlier this 90% provisional refund criteria was only applicable to those who were exporting goods or services outside and had accumulated input tax credit for which they were claiming refund. But now 90% provisional refunds are also applicable to those under the IDS scheme, inverted duty structure. Inverted duty structure, basically, as the name suggests, is those suppliers who have to supply at a lower rate of GST than their purchases. Let's say they are supplying at 5% GST, whereas they bought it at 18% GST. So whatever 12% gap they have in terms of extra GST on their purchases, they could claim an input tax credit for the unaccumulated credit. And for this accumulated credit, they could raise a refund application and get refund. And now, instead of the normal refund scheme, you could also go for the 90% provisional refunds, because it is now open to those under the inverted duty structure scheme also. So for those having unaccumulated input tax credit because of the inverted duty structure scheme can now go for this 90% provisional refund criteria, which is a great amendment as far as liquidity is concerned for these guys under the IDS scheme, wherein now they can apply for provisional refunds at the first go itself. A good amendment in the budget 2026. The fourth one is with respect to refunds below 1,000 rupees. Well, earlier there was a threshold limit for any amount equal to or below 1,000 rupees. If you had exported out goods or services on payment of IGST for an amount below 1,000 rupees, then there was no question of refunds. But now this threshold limit has been removed, which basically means that there is no 1,000 rupee criteria. For any amount of IGST you pay on the export of goods or services, you can claim a refund of it. You are exporting out, let's say, a courier or a package for less than 1,000 rupees from India to another country. For that also you could claim a refund, is now what they are saying. Earlier there was a threshold limit of 1,000 rupees. And finally, it's something to do with advance rulings. Well, the government is trying to bring about a resolution for conflicting advance rulings. Now what often happens is, each state has an authority for advance ruling and an appellate authority for advance ruling. Now, for a similar case in Kerala, you could have a favorable advance ruling, and in Tamil Nadu for the similar case you could have an unfavorable advance ruling. Because of these conflicting advance rulings, there was a lot of confusion among taxpayers where exactly or which advance ruling to actually follow. Now, what is happening is the government has realized this particular conflicting advance rulings happening to date, and because of these conflicting advance rulings, the government had initially thought of establishing a national appellate authority for advance rulings, which is only on paper up to date. Practically, it is not implemented. The budget 2026 mentions that the government has the power to constitute one more tribunal or one more authority like this National Appellate Authority for Advance Rulings to resolve the conflicting advance rulings cases. So basically, there is a National Appellate Authority a kind of a tribunal which is already appearing just on paper, not practically. But the government is saying that it could establish another tribunal or another authority to act like the National Appellate Authority to resolve these conflicting advance rulings. Well, I hope I was able to make things clear in this particular video. If you like the video, you could show support to us by hitting the like button. If you want more videos like these on a regular basis through way of notifications, you could also think of hitting on the subscribe button. Till then, I'll see you guys in the next video. Take care and thank you.